Mina, I want to set up a company to achieve asset protection. Sounds good? Mina, I want to set up a company so down the line I can list on the Australian Stock Exchange. Okay? Mina, I want to set up a company so I can bring on equity holders down the line. Perfect. Mina, I want to set up a company so I can achieve tax minimisation and only get taxed at 25%. I don't know. We're going to talk about this in this video. In this video, we're going to talk about company fallacy. We're going to tackle the fallacy that if you have a trading entity, a trading company, that you're going to be taxed at 25% only. Let's jump into it. Okay, we're going to be talking about 4 parts to this video. The first part, we're going to explain how a company acts. Firstly, a company acts as a silo. If over 3 years, in each year, you generate a profit of 100,000. Over 3 years, that profit will work out to be 300,000. The company allows you to retain these profits within the corporate entity. Each year, the corporate entity is taxed at 25%. That tax amount is not lost. It becomes a benefit in the form of franking credits. Number 2, there is no point of really using a corporate entity thinking it's going to get taxed at 25% when you're earning personal services income. What's personal services income? Personal services income is, as an example, revenue, profits generated by a lawyer working by themselves. It's income that's paid for their skills and their labor. So that's called personal service income. And what happens there is the amounts must be moved from the corporate entity and taxed at the individual tax rates. They cannot be retained in the corporate entity. Number 3, we're going to look at an example where we get taxed on the profit of 100,000 year on year, and where we use the company as a silo, retain these profits over 3 years, and get taxed at 300,000 on that 3rd year. Well, if we get taxed every year on the 100,000 by getting paid a dividend, we would be taxed over the 3-year period $74,901. Whereas if we left the profits to build up, company acting as a silo, build up to 300,000, and then we pull these funds out to use it personally, then we're going to get taxed at $111,667 using the FY 2023 individual rates. That's a difference of rounding up to 40K. That's a huge amount. So you can see here how important it is to plan and ensure that we are operating on a commercial basis and at the same time minimizing the tax legally. Okay, number 4, tax, asset growth, and business planning. When do I use the company as a silo? Well, one example is I need to earn 180,000 per year. In the first year, I've already hit that 180,000 from external income sources, excluding a dividend. So I could say, okay, I don't need to take any dividends out from a company. But say the following year, I know there's going to be an economic downturn, which means instead of generating 180,000 from other sources, I'm only going to generate 80,000. Well, in that instance, I can pull out a dividend of 100,000 and put it into the second year earnings. So I've earned 80,000. I've got a dividend of 100,000. That brings me up to 180,000. And I can do that year on year where I've used the company as a silo and I've built up these profits. That's a very, very effective way to smooth out fluctuations for income. Okay. Secondly, the individual looking at FY 2023 individual tax rates would achieve a 25% effective tax rate if roughly their income was 100,000. So what I could do is I could say, okay, I'm going to pull out 100,000 so I can achieve roughly effective tax rate at my personal level of 25,000. Any amount above that, I'm going to retain in the company as retained earnings. And what I'm going to do is I'm going to use these funds to grow the entity. I'm going to purchase plant and equipment. I am going to hire more staff to help me grow my business. So here we can see how we are effectively capping the tax rate at 25%, but at the same time being taxed at 25% on our individual level where we can actually use the funds to, say for example, purchase a principal place of residence or purchase an investment property in our individual names. So as you can see from this video, leaving profits in the entity doesn't achieve tax minimization at 25% if you're looking to use funds in your personal name. And that is because if, going back to the example, if we leave the profits to build at 300,000 and we pull it out, we're effectively being taxed at a higher amount, 111,667, versus being taxed on 100,000 each year over 3 years, and in that 3-year period, being taxed as effectively $74,901. Now, in this example, we didn't take into consideration franking credits, just to keep things nice and simple and not lose the audience, because this can get quite complicated. Okay. Alternatively, what you can do is you can retain these profits in the corporate entity, but really increase the expenses by reinvesting in plant and equipment, advertising, bringing in more staff to grow the business. Obviously, what that means is as you incur these expenses, the profits will reduce by the expense amounts. But overall, you'll be growing the company at a much faster rate. This video is general advice only. It's not suited for your unique needs or circumstances. It's not legal, tax, or financial advice. Please speak to your accountant, a professional, and they can give you more advice as to how this will work for you, or you can reach out to us and we can look at tailoring the advice for your unique situation. As always, we hope you've enjoyed this video. Please like, subscribe to the video, leave comments providing feedback as to what topics you'd like us to cover going forward, or anything you think we could have done better, or even maybe someone you think we should collaborate with to do a video. We're always looking to develop these videos and work with other professionals to bring as much value as we possibly can to you.